Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, we got a VIP here today.
We do. I'm excited about this one.
Who is it?
We got Blackrock's head of digital assets, Robbie Mitchnick. And I have been told, and we've seen him as like the guy internally who has really turned BlackRock into this sort of Bitcoin force. And not only has he done that, but since the Bitcoin ETFs have launched, especially IBIT.
IBIT's BlackRock's offering.
That's their Bitcoin ETF. And as an analyst, I've never seen anything like this. This has to be like a golf analyst tracking Tiger Woods in the late 90s. What is this? What is going on here? Let me give you some numbers, Joel. So before IBIT, the fastest ETF to get to $10 billion in assets was JPEQ, which did it in 647 days. Okay, that's like 3 years. IBIT did it in 49 days. And Fidelity, no slouch, did it in 77. So think about that. Just let that absorb. That is insane, right? Another one, if you look at BlackRock's ETFs globally, they have over 1,000, like 1,044, something like that. IBIT has taken in more money than any of them. IBIT has taken in 18% of all of BlackRock's global flows this year. Unreal for a new launch, or unreal for any ETF. Even IVV doesn't pull off those numbers. And then when we look at the ETFs in the U.S. year-to-date flows, IBIT is number 2 overall. Only VU, the stud of all studs, VU, is above IBIT this year. So it's top 1% in volume. Again, this is after 4 months on the market. And we see 13Fs come in, which is reported holders. There's already 260 reported holders of this. Normally, a new ETF in their first 13F season will see anywhere from 0 to 5, if they're lucky. So again, this is like breaking records by quantum leap style.
And here we are with the guy who came to BlackRock and said, let's do something a little different. Okay, so joining us on this episode of Trillions, Robbie Mitchnick, head of digital assets at BlackRock, and also James Seyffert, an ETF analyst with Bloomberg Intelligence. This time on Trillions, BlackRock's Bitcoin believer. Robbie, James, welcome to Trillions.
Thanks for having me.
Thanks so much for having me on, and I appreciate the intro. I actually feel like I'm the one with celebrities here because we've all been watching Eric and James, your guys.
It goes straight to their head. Don't do it. So James is a somewhat of a regular on the podcast. Robbie, obviously, so thrilled to have you here. Have you asked Larry Fink for a raise yet?
No.
Okay. All right. So maybe like in the course of the year.
He probably just gave him one.
Yeah.
By the way, I saw Larry Fink on Fox Business. I never see him mention tickers. I mean, because he's got 1,000 of them. But it's like having 1,000 kids. You don't really bring them up. He talks macro a lot. But he was beaming. He goes, biggest launch ever. IBIT. And it's rare. Again, seeing him talk about the ticker, I'm like, that must be a big deal internally if the big man's talking about it.
Yeah, well, I think he's brought a lot of insight and thought leadership to this, right? You think about, we talk at BlackRock a lot about being a student of the markets, being a student of technology, and Larry's kind of the ultimate embodiment of that. So you see that in his journey on this, and obviously he brings a ton of geopolitical and historical context to it.
So Eric ran through some stats about the launch in the intro there, but let's rewind the clock a little bit. When did you first spot the opportunity and go, okay, we got Bitcoin and we got BlackRock. How do I bring those two things together?
Well, I joined actually in the summer of 2018. So coming up on 6 years now. And I had been at business school. I totally fluked into this internship at a company I hadn't heard of and nobody had heard of at the time called Ripple. And that was 2017. And I interviewed for that internship in April of 17. XRP was at 2 cents, their crypto token. When I started 8 weeks later in June, it was at 28 cents. And 3 months after I left in January to go back to finish my MBA, it was at $3. And so that explosive journey, obviously incredible, fortuitous, fun timing. And I knew at that point I had to do something in this space. The opportunity was just too great and too exciting. And it was apparent to me that BlackRock had a lot of potential to be a transformative force in this space. And so August 2018, I started as full-time employee number 1 in the digital assets realm. And it's been a fun couple of years.
Who hired you?
It was really Rob Goldstein, in effect. That's who I first met with at BlackRock, and We had a good conversation. I think some of my ideas were probably a little premature, let's say, at that time. But
what were they?
Well, you might guess. But if you think about 2018, or at that time it was 2017, the idea that we would do a Bitcoin ETF would have been totally premature, right? You did not have the institutional infrastructure. You did not have the regulatory clarity. You frankly didn't have a lot of interest from our clients in this at that time. So as you track through time, our journey, there was a confluence of factors over the years that evolved to get us to where we are today.
You were pitching an ETF, a Bitcoin ETF, even before you were hired.
I don't think I was as reckless as outright pitching it, because I know how that probably would have gone at that time. It really wasn't the time, right? But I would be lying if I didn't think that at some point this was the thing that could happen, and what better place for it to do that than BlackRock.
If you could have taken the internal temperature with one of those internal thermometers at BlackRock for what the temperature for crypto or digital assets in general was at that time you were starting, what do you think it was? What was the...
I think it was pretty similar to just about every large traditional financial institution at that time, right? So predating me, the firm had begun exploring blockchain in 2016. And I think correctly at the time came to the view that this technology, and certainly the asset class, was nowhere near ready for prime time and for our clients. And that was accurate, right? And there's been a bunch externally, very importantly, that's evolved over the years that brought that temperature up to obviously a much warmer level.
So it was not ice cold because it was just warm enough that they could hire you. So like cold.
It's certainly not ice cold.
Okay,
there was a recognition that this could be a thing, right? But that its time hadn't come.
So what's interesting to me is Larry Fink is a major name, just like Jamie Dimon, and a lot of his peers generally were not into Bitcoin. And there was an interview with Anthony Scaramucci on, I think it was the Wolf of Wall Street's podcast. And he says that he had a private meeting with Larry in late 2021 where Larry says Bitcoin sucks. And Scaramucci says, I think you're wrong. You should do some research. And then Scaramucci says it was a young kid named Robbie who came into BlackRock with the idea of creating a Bitcoin ETF. He orange-pilled Larry. And I'm going to give Larry a lot of credit because he actually did the homework. It takes a smart leader to pridefully say Bitcoin sucks and then 24 months later say, you know what? I've got this wrong. BlackRock needs to be part of this. Is that mostly true?
Was the pill actually orange or was it a different color?
I think there's probably a little bit of hyperbole in that. But like I said, we talk all the time about being students of the markets and students of technology. And Larry's the ultimate embodiment of that. And his journey in this space and the work he did in the study through various sources, it shows up in how insightful he is now when he speaks on the topic.
When you're talking about joining and you're interviewing, they're looking at blockchain. That's around the time that Larry Fink's famous quote about an index of money laundering came out. Could you just walk us through, before we move on to talk about the actual ETF, what was the actual process of going from that view in 2018 to 2021, still saying it sucks, to like, all right, actually, I'm changing my mind? Like, what were the milestones along the way? What did you see internally, or even with Larry specifically, that led us to getting BlackRock filing for a Bitcoin
and then
ETF?
Also FTX was part of this. I had to think that almost would take you down a few pegs or set you back.
So first, I think the approach here has always been very client-focused and very long-term, right? So certainly FTX was a bad event for the industry, but our focus was much longer-term in nature than any one company or market cycle. Where it started in 2018, after I mentioned that initial work that happened in 2016. So 2018, where we really spent our time and energy was applications of blockchain technology, right? That was consistent with most of the banks and the other large traditional finance firms. So exploring a dozen or 15 different use cases of how you can use blockchain and the data synchronicity benefits across our business and for our clients. And by and large, most of those use cases across the industry did not work, right? We actually hit on a couple that were pretty interesting and delivered some value, but you didn't see the sort of broad-based adoption of blockchain of everything, right, that some people thought would happen. That was an important period, though, for learning, for building comfort, for understanding the technology. And as factors evolved, starting with, I would say 2020, you really started to see an uptick in client interest, kind of in the post-COVID aftermath, and there's widespread money printing, obviously. Bitcoin went up 13x. You also had a huge amount of venture capital coming into the space, right? We've had almost $100 billion in venture financing the last 4 years. And that's also brought with it a lot of credible human capital too, from big tech, from financial services backgrounds. And so you saw this institutionalization of the infrastructure of the degree that would enable us to potentially build solutions for clients that we could be confident in and have conviction that we could build to a Blackrock and iShares quality standard. And the last piece is the regulatory environment slowly but surely did moderate over time, right? And so when you put those together and then lay that against what we were doing at the time, first in crypto. So we think about this space across three buckets in digital assets, three pillars: crypto, stablecoins, and tokenization. So in crypto, foundationally, we built a partnership with Coinbase Prime starting in 2021. That was a technology-focused partnership, building their trading and custody capabilities and workflows into our Aladdin investment system so that BlackRock or any of Aladdin's other clients who wanted to get exposure to crypto as part of the whole portfolio could do that. We also concurrently developed this private Bitcoin trust, which was really a starting point for us being an asset manager in the space. And that was focused on large U.S. institutional clients, but it was a key solution that we felt was solving part of the problem that our clients were experiencing. Think about stablecoins. We started managing the USDC reserve, or a part of it, in 2021. That relationship grew significantly in 2022, where we became the primary non-bank manager of that $3 billion-ish reserve today, and invested in Circle and started to become a technology collaborator with them as well because of the potential we see for stablecoins. And then finally, tokenization. We did some private tokenization work with JP Morgan on their Onyx platform in 2021. That laid the foundation for us to ultimately do our first public blockchain tokenization earlier this year. So those were all the key pieces that ultimately paved the way for.
Understood. And this reminds me of what's going on at JP Morgan. But again, all that's happening while the CEO does say some things that seem to be contradicting, but clearly he's also has to serve his clients. And well, this is fine. We're serving clients. But personally, I don't get it. Because we do see JP Morgan, Jamie Dimon is basically slams it like every other week. And yet JP Morgan is one of the big APs for IBIT. And some people are like, that's hypocritical. I'm like, it's pretty much par for the course for a lot of firms. Whatever business they're in, like they can't ignore clients, right? So you could actually be in the business without your CEO being all in.
Yes. Although thankfully Larry's been super supportive of this, right? I think he recognizes the level of interest from clients. And I think importantly, the level of frustration that we felt from a lot of our clients, which was, if you want to access crypto or Bitcoin directly, that's been very hard for most of our clients, whether institutional or wealth advisory, right? It's different for retail. Retail has their own challenges too, but for financial advisors and for institutions, almost impossible practically to hold Bitcoin directly. So what they do, they went to alternative exposure vehicles, and a lot of those didn't go well, right? They were often high fee, high risk, underperforming the price of Bitcoin, in some cases all three, right? And so there was this frustration. Now, there are other clients who missed the opportunity entirely. Bitcoin turned out to be the best performing asset in the world the last 10 years. So that was also a bad outcome. So I think that recognition that we were in a position to solve a real frustration for our clients definitely motivated the firm.
I'm going to go to 2023 now. Is that okay?
Yeah.
Okay. I'm on vacation in Cape May. I'm doing my thing. I try to stay off the internet and I try to stay off work email. And I see my Twitter's blowing up because CoinDesk puts out a story saying BlackRock's about to file for a Bitcoin ETF. I remember quote tweeting, I said, this can't be real. Can it? I didn't want to totally shut it down because CoinDesk is pretty good. They've had some scoops. But 4 hours later at 4 p.m, bang, there it is. So my vacation, thank you, was messed up for the next couple of days, but it was exciting. I was like, what? Why would they file? Like, I always thought BlackRock would come out after there's a couple filings and they get launched, and you come out a year later because you don't need to be early. You're BlackRock. But you were like leading the way, and there was no real, I mean, as far as I was concerned, our odds were 1% that an SEC would approve one. And
on
then,
that day, on June 15th.
On that day.
Okay.
And it immediately went to 50.
Right.
Because BlackRock's BlackRock. And so the whole thing was, what does BlackRock know? And then there was these conspiracy theories that like Larry was talking to like Gary and the head of the SEC.
There were
like,
a lot of conspiracy theories.
Yeah, there was a lot. It was like, well, remember, BlackRock is a big time company. You helped bail out the whole economy basically with buying bonds with the Fed in 2020. So BlackRock is like just a monster company, different than any other company, in my opinion. This wouldn't have been as big if Fidelity or even Vanguard filed it. So anyway, everybody went crazy. The internet blew up. I mean, you broke the internet that day. I wasn't sure. I didn't know. I thought maybe they saw a grayscale lawsuit and you saw that, hey, maybe the SEC is going to lose. We should file now. So my question to you is, what drove the filing that day at that time versus, say, just waiting a while until the SEC comes around and then you can come in a little later and do your thing?
Yeah, well, I think that we were ready and our clients were ready, right? That was the big thing. We had laid out all those foundational pieces from the technology side with Coinbase and Aladdin, from the Bitcoin private trust side, and had conviction that we could deliver an iShares quality product in this space. And it was increasingly clear that our clients hungered for that, right? That at the end of the day is what it was.
You knew that you could decrease friction and cost, which is sort of what Larry did say on Fox Business when he went on. And I agree. I mean, ETFs are so good at that. I get it. Again, it was just a little bit of a shock. We figured usually the first one to throw in their hat is like a Van Eck or a Grayscale. It was like, BlackRock? Playoffs.
So I will say, I maybe downplayed what Scaramucci said in your question earlier, but to his credit, he did in the summer of 22, when we launched the private Bitcoin trust, he connected the dots and said, I think this is a precursor to them doing an ETF, which was a pretty good call.
Yeah, I mean, like you said, our expectation was like people like Vanguard and BlackRock are next. We're like, Vanguard's never going to happen. But BlackRock, we think that will probably happen, but we didn't think you'd be first or in with the first guys. So you talk about clients wanting this. I guess, what are the client questions you're fielding? Or what were the questions like 6 months ago versus what are the questions now? What type of conversations are you happening with those clients that wanted you to do this?
A lot. Pretty steadily through, we're 4 months in now. We've had hundreds of conversations across our client base, right? You can think of kind of our main distribution channels and Investor Direct, which right out of the gate, they were buying. There were no hurdles to them getting access. That's been, I think, the largest source of flows for sure. Second being wealth advisory channel, and third being institutional. And those latter two really operate on a longer timescale, right? There's a much longer, as you guys know, education, research, diligence journey that underpins their process. So it's a lot of conversations with our wealth advisory partners, with home offices who are considering, the approval process for this, because many of those platforms, it's available unsolicited today, right? You guys have covered this in the past, but not on a solicited basis. So that's the process that they're going through. And then institutional, when this happened, it restarted, in many cases, those conversations of crypto or Bitcoin. Should we be invested in this, right? That in some cases that firms have been having those conversations in 21 and 22. For some they hadn't had it yet. But this was the moment where they said, okay, we better figure out what this thing is and how it fits in a portfolio. And that's kind of the education that we've been doing.
Let's go to advisors for a second. When we saw the first inflows and the trade sizes for IBIT, it looked small. It looked like a bunch of minnows biting, right? Occasionally a big bite, right? Big trade. The 13F's showing that there are advisors buying, a couple hedge funds, no major institutions yet. But when you look at all ETFs, I think advisors are like 70% of the assets. Like they're the biggest users of ETFs generally. And there's been this sort of debate on Twitter lately about whether the boomer advisors are really coming. And let's bring up this part about solicited versus unsolicited. So what you're saying now is that only if a client goes to the advisor and says, I need this, can they buy it. But over time, the advisor will be able to solicit it to their clients. And where are we? What inning are we on the solicited
Sure.
part?
So the standard process for new ETFs, right, is typically a multi-year journey from launch to actually being approved for solicitation, right? And so I think what's happened here, given some of the historic demand that we've seen around this that you talked about, Eric, there's been an acceleration of that process for a lot of these home office platforms at the wealth advisors. So that's a long journey. There's a very intensive diligence process that goes into that. There's also an education process. And so we're going through that with them. Some will be faster than others. That's just the nature of it. But certainly over the coming months, we would expect to see some of those approvals come online. The institutional piece is interesting. You mentioned that. Remember, on the 13Fs, that's as of March 31st. So over the last couple of weeks, you've started to see some of those institutional conversations come to fruition. And I think people forget with the end investor direct, people say, okay, well, that's like small dollar retail. Not necessarily. We have within that bucket a number of very large positions, right? So we're talking about many of our holders are in the ultra high net worth category, holding in some cases 9-figure positions, right? And what we found, we've been surprised by some of the ways that IBIT has resonated with investors, even large existing Bitcoin holders. One of them that we found is very large holders like the fact that, well, one, it's extremely liquid, right? IBIT trades IBIT USD larger than many of the crypto exchanges in the world that have been around for a long time. And you don't have to show your hand in moving Bitcoin to an exchange, right? So whales hate the fact that people monitor the blockchain for when Bitcoin is being moved from large wallets to exchanges. They don't have to tip. And so we've seen actually a lot of very large Bitcoin holders come into the product for that reason.
That is really interesting. In my first book, which I'll plug here, Institutional ETF Toolbox, which Joel's read 18 times. I remember institutions love the anonymity. They love that. They also love liquidity, anonymity, and freedom. And it sounds like that's what you're talking about. Now, liquidity had to come, and you're trading $1 billion a day, which is that's what they need. So that's interesting that I do agree institutions will bite probably more on that. That's why I think you're like the GLD. There can only be one super mega liquid one. It looks like you're going to be it. Fidelity's is pretty liquid, and the others are pretty liquid, but none are in like the top 20 most traded every day consistently like IBIT. So you get liquidity, Joel. That's like the best big fish bait there is. Pool. Yeah, it's like chumming the water.
So you talked about these whales and people buying IBIT. I mean, what percentage allocations of a portfolio you're seeing? Are you seeing people like you always hear everyone saying 1 to 5% or something. Are you seeing people doing way more than that? Are you actually seeing the 1 to 3% when you're talking to these clients? Like, how are clients looking at IBIT and just Bitcoin in general?
Yeah, I think that's probably the most intensive part of our conversations and the education journey right now, frankly. And it varies by investor type and risk preferences, and et cetera, right? So there's no kind of one size fits all, but we're doing a lot of education with our clients around that. And I would say 1 to 3% is probably the most typical range for those who are allocating.
And we talk about allocations. How is it being positioned? Because I see people there's a big spectrum. There's the hardcore people who are all in. This is like their religion. They think 60-40 is a scam. We'll move them aside for a second. They're a special breed. Then there's sort of the more normal 60-40ers who are like, yeah, I don't want to kick myself if this goes to $1 million, so they buy 1-2%. I would consider that hot sauce. Now, some of the Bitcoin issuers will try to sell this as something that lowers your overall portfolio volatility. It's like digital gold. But if you compare Bitcoin to gold, Bitcoin makes gold look like a money market fund. To me, Bitcoin would be like double black diamond ski slope, whereas gold is like the bunny slope in terms of volatility. Are people understanding that it's hot sauce? The one thing I fear is that they look at it as gold, but it's not going to move like gold, and that they need to make sure that they are ready for this roller coaster ride. Is that how do you brace them for this?
Certainly, that's part of the education journey. But I think, Eric, you've hit on what is probably the most important debate in the space right now when we think about investment thesis, risk, portfolio construction, is the nature of Bitcoin's risk. And the reason I think it has so many people confused is Bitcoin has this duality to it, right? On the one hand, it's a novel technology disruption, right? It is potentially a global payment instrument, right? It's very early in that journey. It is something that, on that basis, as a sort of technology play and a beta of some sorts to blockchain adoption, you would expect it to be highly volatile, correlated, and would look more like tech or VC in a portfolio, right? And on the other hand, it is a global, non-sovereign, scarce, decentralized, global monetary alternative of sorts, right? And so that's where the digital gold thesis comes from. And there, you would also expect it to be volatile because it's early in its adoption on that journey, but you expect it to be uncorrelated and a potential hedge to some of these risk factors, inflation, monetary debasement, geopolitical, et cetera, right? And that's where the tension comes in, because how you think about it in a portfolio depends very much on which of those narratives prevails. I think the direction of travel is increasingly towards the latter, because fundamentally over a longer term, I think that's the bigger component of what drives Bitcoin. But it's going to have short-term episodes where there's a lot of noise around that. So people certainly have to be ready for that ride.
I thought of the best catchphrase for it. It's like gold, but as a teenager. You know, it's out partying,
exactly
breaking
it.
all the rules.
That's exactly it.
Expect your car to get stolen in the middle of the night, like all that kind of stuff. It's not going to be dull, right? Gold is 8,000 years old. This is like gold is like a 17-year-old, Joel.
To be fair, the common phrase that people meant, and including me for many years, have been using is a call option on a store value asset, which is like a monocle poo or super smart brain version of
one of those
gold
is
as a
catchier than the
teenager.
other.
Yeah, but like a call option in a store value asset is what a lot of people have been referring to it as.
The other description I heard that I thought resonated was some guy, this retail person on Twitter, just the regular guy, is like, it's like the Second Amendment for money. Which I thought about it, I'm like, I get that. It's like protection from your own government from devaluing the currency, which honestly sends wealth right up to the top. And so this idea of like devaluation and you have something to protect yourself from it, how much does that resonate with advisors versus just simple, hey man, this thing is cool, I don't want to miss out if it goes to $1 million?
It's some of each, but I think that in the US and Europe in particular, that first piece is a little bit harder to grasp, right? The US has enjoyed this incredible run of, in the post-World War II era, basically 8 decades of pretty remarkable stability and prosperity, right? And that is an outlier in human history, in financial history. And so it's harder to grasp why you would have to worry about the debasement of money or political dysfunction, destabilization, et cetera, for an American, specifically those of an older generation. The reality is, around the world, there's about 4 billion people who live in some sort of non-democratic regime, right? You got about 2 billion people who live in hyperinflationary or severe inflationary monetary regimes. So for those people, this is very real and they've lived it. For Americans, it can be a little bit more amorphous, this concept.
When you guys are talking about this, what do you think it's correlated to or inversely correlated to? Are you looking at the dollar, real rates, like what inflation? How do you guys talk about this with clients from a correlations point of view? You've danced around it with a lot of this talk, so let's dive right in.
The correlation is super, super important, right? Because volatility is volatility, right? And because it's so volatile, we'd not recommend it in large concentrations in a portfolio, because then the volatility really starts to add to risk. But at smaller concentrations, the correlation becomes the key factor. And fundamentally, from a macro perspective, you can sum up most of Bitcoin's correlation where it exists to so-called risk assets based on real interest rates, right? Bitcoin is massively short real interest rates. It is short nominal rates, and it is long inflation expectations. And you look at the charting of this, it's quite striking. And of course, the alternative way of thinking about it is versus the dollar. And Bitcoin is also very inversely exposed to the dollar. And of course, the dollar and real interest rates have their own pretty tight correlation. So that explains most of the correlation that exists. Because fundamentally, on other metrics, you'd expect that correlation to be low or even in some ways a negative.
So the pitch should be basically inversely correlated to real rates expectations in the dollar, but also the volatility. You talk about the volatility as a bug, but I think of it more as a feature. If you look at any of this research, if you do any sort of semblance of regular rebalancing, whether it's quarterly, semi-annually, or annually, if you can manage to sell when it's going way high through the roof in these massive bull markets and buy after it's collapsed 80%, which happens pretty much every single cycle, that's where a lot of this Sharpe ratio seems to come from, any backtest analysis that I've done. So is that the pitch you're giving to these advisors? Do this, put it in allocation and just rebalance it and make sure you do it properly?
Well, I think that market timing is easier said than done, right? Because sometimes it may look like the top and it's not yet, and sometimes it may look like the bottom and there's a ways to go yet. So historically for Bitcoin, the best way to trade it was to buy and hold it for a long period. And the people who had the discipline to do that over the last 10 years, 15 years did extraordinarily well. So we're certainly not trying to advocate market timing for...
Sorry, I just meant regular rebalancing, which I know like some Bitcoin believers here out there are listening to that, and that's like blasphemous to
Well,
them.
let's talk about behavior, because I frequently debate this. When the Bitcoin ETFs were taking in money, all of the degens were thrilled. They're basically celebrating, and then they top off a little. There's other sellers. The ETF flows seem to be somewhat driving the price, but there's definitely the ETF flows have the price going up, and then you can tell there's actually like whales selling or somebody else. Like clearly it's not the ETFs. Then the price kind of flatlines and the ETF flows follow, which is normal. But in the past sell-off, there's been like a month of like shaky flows. I think it's added up to about 3% of total assets. So not a lot, but everybody's, oh, look, the boomers have lettuce hands.
Yeah.
And I'm like, first of all, it's 3% of the assets. Second of all, ETFs are hotels. People come in and out. It's the way it is. And then I do think that ETF investors are usually heads up. If you're smart enough to know what an ETF is and use it, you've probably used one before, and you probably have this as a small allocation. This isn't like the whole enchilada, so you can stomach more volatility. So my view is there will be some outflows, but over time, I think these are more diamond hand investors than some think. Is that true?
Well, certainly our client base, I think, is taking more of a long-term buy and hold view than a lot of the sometimes frivolous trading activity that happens more broadly in crypto markets. Ultimately, the ETFs are an access vehicle, right? They're an efficient, convenient access vehicle that has taken away frictions from some portions of the market that historically may have liked or wanted to participate in Bitcoin who couldn't, and now they are. And I think ultimately that's making the market more efficient and more liquid.
So talking about an access vehicle, we've talked about institutions a lot, but like 13Fs we've seen, granted, there's still some time left before they all file, but like when are the institutions coming? I mean, for forever, you've been hearing people on crypto Twitter and elsewhere saying the institutions are coming, the herd is coming. But when are the institutions coming?
I think crypto Twitter also thinks advisors are institutions. Crypto Twitter thinks anybody without like a Coinbase account is like an institution, right?
I think some parts of crypto Twitter.
Yeah, they just think someone wearing like pleated khaki pants who golfs. Like that's like the institution for them.
Well, I'm talking about endowments, pensions.
Someone said Bitcoin ETFs are for your parents. That was like I forget what article did, but I thought that was a pretty accurate. This is the boomer. The boomers are coming.
We talked about those three buckets, right? And investor, direct, advisory, and institutional. Institutional is the longest time scale for sure. There's a very significant research, education, diligence process that is going into it. And I think that we're still very early on that journey. Obviously, there are a handful of institutions who over the years, a very small number who allocated to Bitcoin directly, who overcame the pretty significant frictions to do that. A little bit larger number who allocated to the sector, to the technology or asset class more broadly, typically through funds. Venture funds were a popular way to do it. But it's still early. What I can say is there's plenty who are on that research journey, and that's part of the education that we're doing every day.
What do you think's next for the crypto industry as a whole? I mean, now that we have ETFs trading, what does it mean for the rest of the industry?
Obviously, there's a much longer tail of crypto assets than Bitcoin or Bitcoin and ETH. For us, for our clients, their interest overwhelmingly has been in Bitcoin, a little bit in Ethereum, and not a whole lot in that longer tail of 10,000 plus assets. So I think it's important to make that distinction between the two. Certainly there's some great projects out there in that larger group of assets, but there's also been a lot of pretty frivolous projects, right? A lot of tokens that have been flash in the pan and they've come and gone, and there's been, hype associated with them that hasn't been backed up by real economic substance. So it's going to be a long journey for some of the rest of crypto to really start establishing product market fit and economic use cases before they start to cross that chasm into what we've seen, obviously, Bitcoin become.
So Bitcoin maximalists, bull.
Well, maximalist would be a little strong,
okay.
But certainly it's unique in its where it is today.
We've seen when they launch Bitcoin and Ether together, whether it's futures or like in Hong Kong, they launched both at the same time. I think ETH got 15% of the assets.
20, over 20.
20?
Yeah, a little over 20.
Yeah, I think it was a little less. He's more bullish than I am.
It was.
I
It's
think
over 20.
ETH is, to me, Bitcoin is the headliner. And ETH coming out next, if it ever gets approved, would be like the opening act coming out after. So I'm mostly focused mentally on the Bitcoin ETFs. I think ETH also speaks to what I was going to ask you next, which is tokenization. And I wanted to ask you about that because when Larry's on Fox, he does talk about the Bitcoin ETF, then he pivots to tokenization. Now, are you talking about tokenizing everything so that Microsoft shares and even your own ETFs are tokenized? Or are we just talking about tokenizing things that are hard to get, like artwork or farmland in Iowa, where you can just now places ETFs can't go? What are we looking at in 10 years?
So I think if we go back to that 3-pillar framework, crypto, stablecoins, tokenization is by far the least developed of those three right now from an industry perspective, right? That said, there's a lot of excitement around it because the potential future state, and I don't know whether this will be realized, I don't think anyone really knows, but it's certainly possible, of a world where a blockchain-based digital asset token becomes the primary format for the majority of investment assets and securities, right? That's a possibility. And that is a really interesting world in a lot of ways for something that becomes global, universal, digitally native, transparent, instantaneously transferable, programmable, all these attributes of tokenization that are behind why there's so much optimism for it. And for us, it's a story of how does this increase access and lower costs for our investors. The substance today, though, is that tokenization has not yet taken off at scale in any meaningful way, right? And so there's a lot of work happening. I think what you need to see is a coalescence around what are the right asset classes to start with. Forget about where we're going to finish and what's going to be included in that. Where do we start so that we can say, there's a geography, there's an asset class that we used to trade and settle an issue this way, and now we primarily do it using a digital asset token. And then having the custody and the trading and the regulatory support infrastructure to actually make that happen, we're just early in that journey.
Let me ask a similar question in a different way, which is there anything that the ETF can't do?
ETF's a pretty good wrapper. It's popular for a reason. I haven't thought about that question, though. I'm gonna have to get
I
back
think
to
some
you.
of the crypto crowd underrates the disruptive ability of the ETFs. I think they think crypto is the big disruptor of everything. But ETFs, I think, are going to push down costs from the exchanges. If you're doing direct indexing for advisors, you're probably charging 1%. You're going to get pushed down. There's nothing like a highly liquid, cheap ETF, and the U.S. is full of them, and these are already at 20 to 30 basis points with $1 billion in liquidity. I can't overstate how powerfully attractive that is to every investor. We're probably going to see people come over from other countries who were big investors just to get that. It's just hard to compete with that.
Yeah. So what's interesting, comparing the ETF and a digital asset token as a wrapper, if you look at the two major announcements we had this year, obviously IBIT in the digital asset space and our tokenized yield fund on a public blockchain. And they do the opposite of each other.
Yeah.
Which is IBIT takes a crypto asset underlying investment and puts it in a TradFi wrapper, an ETF wrapper, right? And a tokenized fund takes a TradFi underlying investment and puts it in a crypto wrapper. And you might say, well, that's contradictory. But it's really not, because what it's a reflection of is across our client base, they're at various stages of their evolution and have very different preferences around infrastructure and access method, et cetera. And so for a lot of our clients, certainly the majority of our clients, the ETF is a much more efficient, convenient way to access something like Bitcoin. And for some of our clients who are now crypto fluent, or they're active in digital asset world and they're used to blockchain wallets and settling on chain, they love the idea of having a BlackRock fund that is digitally native, instantly transferable, et cetera. So both are happening in parallel. And perhaps one day we see a convergence that's the best of both, but I think that's a long way off.
We're coming up on a deadline for some spot Ethereum ETFs. You guys have an active filing, but what are the prospects internally? Do you think we're going to get an Ethereum spot ETF?
Given it's an active prospectus, I can't comment.
If
on
they
that
don't
one.
get approved, they'll be 575 and 2.
This is a
in terms of
question.
approvals. That's it. Look at, hey man,
Here's an
I can
actual
assure you
question.
it's never come up.
Yeah. Is that was people were like, BlackRock's not going to file if they think they could get denied. In my mind, I was like, BlackRock doesn't care if they get denied and their record is, they're trying to get it approved. Do you guys talk about the idea like we can't tarnish our record?
We're a lot more focused on the client outcome than the
and I
approval
put
record.
that number out there, which Fox never gave me credit, but that's okay.
Yeah.
But it wasn't to say they're focused on it. It was just to say this is how powerful and not messing around this company is, right? That is some record, right? Speaking of that, like the in-kind versus cash creations, just to get wonky, in-kind would be ideal for the industry, but SEC would only allow cash creations for these spot ETFs. Looks like they're doing fine. It wasn't a big deal, but I know in-kind is what you wanted and others. You didn't get it, which proves that BlackRock isn't dictating things. Do you think we'll get in-kind in the next year or two?
I hope at some point our views on it were all public in the SEC discussions that we had with them on it. And ultimately what we're focused on is it's even more efficient from a market structure perspective, better for investors that way. And there are a lot of clients, frankly, who have large Bitcoin positions and they would like to hold some or all of that in an ETF. But without in-kind, they would have to incur a tax realization. And so there's some eagerness from those folks to have that.
Crenshaw, who's one of the commissioners, I've heard is the driving force behind us having cash rates and not having in-kind, who's a Democratic commissioner. So depending on what happens in November with the election, like all these questions could be completely different. Yeah, could be moot because I think a Republican administration will be much more amenable to in-kind transactions.
What did you learn about yourself through this?
I wasn't expecting that one.
Yeah.
I think that, patience was not something that I would say I necessarily have a lot of, but I have maybe a little bit more than I thought I did. And I think that for big things to happen in an industry, you have to be very patient, right? These things take time. Obviously, the digital asset space has had a pretty seismic shift over the last decade. But any given year, people might have said, oh, this is all not happening fast enough. And if we look back on where we've come as an industry and as a firm, what we've been able to do, I think it's actually pretty cool.
Capital One question. What's in your crypto wallet?
Oh, boy. There's obviously some Bitcoin there.
Is it IBIT or Bitcoin?
It's both.
Okay.
It's both. Yeah. There's some ETH there. And what's in beyond that, I'm not going to say. I'm not trying to create any market moving events here.
Probably for the best not to answer the rest
By the
of
way,
that
the
question.
XRP people are the craziest. Can we agree on that?
Yes.
No comment.
When they put that forged XRP thing out, and I called you guys, and they said, this is not true. I said, it's not true. The price went down to normal again. And for a week, they just dragged me. Yeah. They were like, this suit doesn't know anything.
It was longer than a week.
Yeah.
They refused to accept
really
that it was
wild.
fake.
I mean, there are some pretty intense elements to a lot of these token fan bases. It's not just XRP.
All right. And then we got to talk about the ticker for a second. We always ask at the end of the show, what's your favorite ETF ticker other than your own? IBIT, also pretty good. I want to ask if there was any other tickers that were in consideration at BlackRock.
Well, you hated the ticker, Eric.
The first one.
You dragged us.
No, IBIT was fine. The first one was not good. It's the same as a bond ETF in Europe. It was like
IBTC. Yeah.
It's too many consonants.
Placeholder ticker.
You got to have a vowel in there, man. It's like Wheel of Fortune. Give me a vowel. And if you can make it a verb, and it's even better.
Yeah. I would say, I don't know. I grew up in Toronto, and I got to go with cow and moo.
Yeah.
Right? Those are two good ones. Cow's one of ours. Moo is a Van Eck one. But, my cousins growing up north of the city, they had this great farm, and they raised cows, had fun hanging out up there and have a lot of fond memories.
All right. Robbie Mitchnick of Blackrock, thanks so much for joining us.
Thank you. This is fun.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Bye.